With blistering inflation and hawkish Fed, bond traders push for safety. New York bond traders are embracing safety in their portfolios as volatile markets charge in a supersized hike from the Federal Reserve following proof of scorching inflation. Investors have significantly shifted their expectancies about Wednesday's selection to a rate hike of 75 foundation factors (BPS), not the 50 bits per second the marketplace become expecting final week. The expanded hawkishness has sent equity markets tumbling and bond yields surging, briefly inverting the yield curve and pushing stocks right into a undergo marketplace. Many buyers assist the Fed shifting quicker to dampen inflation, however they worry about the chance of recession. A Marvel 75 basis point hike could be a glad one, said Nancy Tengler, leader Gov officer and chief investment officer at Laffer Tengler Investments in Scottsdale, Arizona. The question is whether the financial system can keep away from recession, and that would rely upon what the Fed does. If the Fed raised by 50 and they say they're willing to recollect 75, then we understand that they are no longer going to get in advance of inflation. You need to front-end load the hikes. Tengler stated her organization has been shielding in its bond portfolios, shortening duration and increasing the underlying fine of the property. Shorter duration debt commonly outperforms longer-dated debt in a rising price environment. Overall, futures on the Fed price range price, or the fee on unsecured overnight loans among banks, now reflect an 87% threat of a 75 bits per second charge hike on Wednesday, and a 75% possibility of any other such increase in July. The market has additionally factored in a Fed finances rate of 4% by way of the summer time next year. Pershing Square Capital Management founder and chief executive officer Bill Ackman, in remarks on Twitter NYSE, TWTR on Tuesday, pushed for multiple 75 bits per second hikes, noting that market self-assurance within the Fed can handiest be restored if it grants on what the marketplace expects. Graphic. A sharp shift in Fed rate hike expectancies. A sharp shift in Fed rate hike expectancies. The Fed has already raised quotes by way of 75 foundation factors this 12 months. It also started out to cut back its stability sheet this month, a method called quantitative tightening. The Fed's stability sheet ballooned to nearly $9 trillion as a part of its pandemic coverage, lodging the latest large spike in inflation become a prime catalyst to the shift in expectations. Last Friday, facts showed that inside the 365 days through May, the U.S. Consumer Rate Index (CPI) surged 8.6%, the most important year-on-year increase in roughly 40 years. Graphic. Inflation. Bond market bets ahead of the Fed selection. Fixed income market gamers have stored quick period bets. Some, however, have decreased those short maturity trades, believing there are opportunities within the marketplace given how credit score spreads have widened and the way costs have risen notably because the beginning of the 12 months. We are still brief period, albeit to a lesser diploma. We were upgrading the best of our portfolios beneath the premise that choppier markets and tighter monetary regulations must motive credit score spreads to widen, said R.J. Gallo, senior portfolio supervisor at Federated Hermes (NYSE) FHI in Pittsburgh. His portfolios are also slightly overweight treasuries, and even though their duration is brief, we nevertheless just like the high-quality nature of treasuries for playing protection. But regardless of the Fed's competitive tightening, bond buyers see possibilities within the fixed earnings space, and for a few, it can be time to begin transferring away from safety bets. At this point, being pretty conservative from both a credit and period standpoint isn't always the proper area to be, stated Jason Brady, chief executive officer at Thornburg Investment Management in Santa Fe, New Mexico, overseeing $46 billion in property. That's in which we had been, and we are moving away from that. From a credit unfold standpoint, Brady stated his corporation has become marginally much less conservative. Brady, for example, cited U.S. excessive yield debt, with its spread to Treasuries widening to 487 foundation factors on Monday. On top of a 3.5% yield in U.S. 5-year Treasuries, he referred to that an investor would net a more than 7% yield. That's not terrible. David Petrocinelli, handling director at broker-dealer and SpareX in New York, has also been advising buyers to be protecting in bond portfolios since the fourth sector of last year, but nonetheless believes the Fed may want to gradual the pace of tightening later this 12 months. He recommends a barbell approach, which mixes brief and lengthy maturity bonds.